Oh, that's right. Another month and another stocks to buy. Hope you're excited about this. We got 4 of them for you today. I think we found some good values in the market, okay? Still, we're seeing some pullback lately, so there's a lot more compelling buys as of late, if you ask me. And I've been partaking in a couple, but let's get into 4 that we got. We try to do different industries here, so we usually start off with tech, and here's my tech play. Look, you've heard a lot, Meta platforms. We're going to be buying Meta platforms today. Formerly known as Facebook, you obviously might know that. Interesting switch as 2021 has become the year of the metaverse. There's a good reason why I say Meta platform. So I like this company a lot. I've liked it for a long time. And you know how I really like it? I really like it when you talk about that since August. That was a dog toy that was making weird noises. You might know that dog toy. This is down 18% since their highs in August. Year to date, they are up, but in the last 6 months, down 6%. Look, this has been a company in the last year that's only gone up 7.5%. Has really trailed the market, which is kind of crazy to think about. You would expect a lot better numbers out of a company that's as quality as Meta Platforms or Facebook. So what qualities do we have here? Well, we look at Yahoo Finance, not the greatest platform out there. Trust me, Yahoo's kind of garbage. But we look at the statistics here. This is a stock trading dirt cheap in comparison to historical anything historically. 22 forward PE or trailing PE ratio, 21 forward PE ratio. It's cheaper than they've ever traded. Price to expected growth at 0.86, again cheaper than they've ever traded. Price to sales under 8 is cheaper than they've ever traded. This is a company that's trading at very, very cheap valuations in comparison to historical averages. They're just very cheap right now because of their recent stock pullbacks. And you look at the revenue line, which I think it's better stated here when you look at annual revenue, and you can see the massive growth they've been able to show. Massive growth, $86 billion last year. And if you look in the trailing 12 months, $112 billion. This company is growing revenue at astounding rates. And on top of that, the net income line is continuing to grow by great numbers as well. You see the black line being net income is, you take that and just do that. I mean, the net income line it's picturesque, frankly. How they're skyrocketing the net income line. It's beautiful things for this company. And that's what you really like when you look at a company, is one that's able to produce not just revenue, but also an incredible amount of net income to where they're not reliant on any outside financing ever. They never will be, because they're producing so much net income. And that's a trend that's going to continue with this company. Look, as they refine the business and they continue to do great things. Now, how does Facebook make money? Obviously, it's worth mentioning. Majority of the revenue here you'll see is made entirely via advertising revenue, which even last year, ad rates were down. And guess what? Here we go, showing great revenue growth last year. One thing I really like to see here too as well is the other segment. I like mentioning this other segment because you wonder what is other for Facebook. Well, there's multiple different variations of what other are for. They've got augmented reality devices. You're talking about the new Ray-Bans. They're really focusing on producing some hardware now that you might not see normally. You've got the Oculus Quest. Facebook owns Oculus. Obviously, you got to consider the fact that virtual reality, as it becomes more affordable and more regular technology, a lot of households are going to be using virtual reality technology, okay? And with that, I think Oculus is one of the main players in the game. I think that goes without saying. They have a lot of different options, from the Oculus Quest to the Oculus Go. Look, they've got a lot of options here with the Oculus, and I think that'll be a great part of this other revenue, because it'll not only look. Okay, I have to be honest with you. At some point, ad rates will keep going up, yes, but user growth eventually will stagnate off. It just has to. It's just how life works. I mean, there's only so many people that have access to the platform at a given time. And eventually they can hit a limit to where, everyone that doesn't want to use the platform won't be using it. and they refuse to use it. And the people who want to use the platform, they've reached their market. It's eventually not any time in the near future, by the way. They're going to continue to grow users significantly for many, 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 many years. Okay? Then they're going to be reliant on ad rate growth, which obviously will grow over time. We already know this, okay? That's just how it's going to go. But you got to consider that other revenue could really carry them in the future. We saw 195% growth in this line year over year. I think this could be a massive, massive segment for them in the future. If they're able to grow this other segment and make it a larger percentage of the revenue. Seems pretty exciting to me. If you're me, I think that's pretty exciting. So what else do we like? We like the user growth here. Again, as I mentioned, consistent user growth always. Look at this: monthly active, daily active, average revenue per user. You see growth there. You see daily active, family daily active, people and family monthly active continues to grow, and average revenue per user. Again, as that increases, that's where this company continues to just churn out profit. It's beautiful. So I like Facebook a lot for the future, or Meta platforms, I should say, but mostly we're talking about the Facebook platform. I get it, but Meta platforms, it's a beautiful, beautiful company, and trading at a pretty cheap valuation right now. I think it's worth taking a buy, because again, if you buy at these levels, I'm a long-term guy. If you buy at these levels, 5 years from now, when this stock has doubled in value, you're going to be pretty excited about it. You're going to be happy when it's trading at $600 a share, or split. You never know what happens, but you buy it now, you're going to be very happy in the next 5 years. I'll just tell you that, regardless of what happens in the market, in 5 years, this stock will be up way higher than it is right now. That's what I got for you. So next is going to be a little bit of a different one. Not one I don't typically, I don't bring solely high dividend yielders into the market here, but there's a lot of reasons why I like Omega Healthcare Investors, okay? I think this is a stock that's been, unfairly maligned as of late. On the year, down 21%. 1 year out, down 25%. And if you look over the last 5 years, they are slightly down. So there's a lot to consider there. They showed pretty good growth after their 2020 dip, which, by the way, was ridiculous, because if you go to their highs down to their lows, this is a stock that fell 50+%. And then since those lows, they recovered pretty well into early 2021, up 71% there, and then they've since fallen down significantly, again over 25% in the last 6 months. As you can see, they're 27% in the last 6 months. So they reached a good point, and then the stock kind of started falling down again, and I'm curious why that might be. So it's worth taking a look at, and I honestly don't know why. I can't tell you why. So this is a company, if you don't know, that invest in properties that are typically going to be stuff like assisted care facilities, otherwise known as old people homes, old folks homes, so there was a big concern last year, and that's why they dropped so significantly, because of people like, Governor Cuomo, who, sent people to die in nursing homes and didn't care about it. But look, let's forget about that. So there was a lot of concerns with everything going on right now that this would hurt a lot of them, but they've recovered significantly, and you can see that in terms of their revenue line. Look, this company was phased last year, and they've already recovered past to where they were before. They've already recovered it. What else do you want me to say? They were showing very slow growth before that, which isn't like, it's not a nightmare situation for me. Slow growth. They capped out after this 2016 line here, but I see growth again. You see this is the best number they've put up in a long, long time, and you should be pretty excited about this company, especially when it's trading at pretty darn cheap valuations. And again, you're not necessarily going to look at a P/E ratio on a company like this. You care more about a couple other factors here, which, if it shows, which of course Yahoo Finance wouldn't show the kind of numbers we're looking for here. But, I like net income line here. I like some things about this company. What can I say? Trading at cheap valuations, in my opinion, for what they're able to do. Look, and again, my main buy here is going to be on the dividend 9.76% yield here. They have shown growth rate in the last 5 years, but technically no years of growth. And why is that? Again, it's a high payout ratio because it's an REIT. REITs are required to for tax breaks to make this happen. But again, typically you'll see it around 90%. Still at 80 is not bad at all. But what I like here is the dividend history. Look, this is a company that was dedicated to growing the dividend. You look in the last, I guess you could look at the max of this company. The tech bubble, it just bombed it. Okay, it bombed it. But if you look at this company through the financial crisis, look at this. Look what they did. Look at it. They didn't lower the dividend at all. They didn't grow it for a little bit, and we're going through the same period right now where it's halted at 67 cents solely because of the macroeconomic environment. But once we get past that, and it wasn't until 2020 that they really halted growing that dividend, so they're going to continue growing it within the next year. They will. It's beautiful stuff. I like it a lot. I mean, what can I say? Look, this little I don't know why they have this as separate things, but overall it's still growth. Look, I don't know. But they were nearly growing every single quarter 1 cent. And I don't think they're going to get back to that, but I do think they will get back to growing by, in my opinion, I think they'll grow to start a penny every year, which is fine. I'm fine with that. Any dividend growth is beautiful, and there's nothing that's scaring me about this stock. I think it's trading cheaper for a great starting yield that I think will be growing in the future. I don't know why people are selling out of this thing. It's going to be a consistent play. It's not one that moves a whole lot, and I don't buy it for share price appreciation by any means, because it won't be that way. This is going to be a beautiful, guaranteed 9% yield. And that's all you can ask for. 9% a year. That's more than the market gets you on average. So, who's going to be upset about that? I'm not, that's for sure. That's why I've been buying more. So, then we get into retail. Okay, I have retail in here quite a bit. Look, retail's been unfairly maligned again. I don't really know what's going on. You look over the last month, Target's down 6%. In a year in which they've been continuing to grow year over year over an incredible year last year. Year to date, they are up 37. I'll give you that. And last year, up 38. But if you look 5 years out, massive stuff. 212% growth. This has been an incredibly high-performing stock, and I've loved to have it. And it's at near all-time highs, so why do I like it? Well, there's many reasons why I like it. I look at the valuation, and it's still not trading that expensive by any means. It's really not. 18 PE ratio, forward PE ratio, also at 18. Nothing crazy there. Cheaper than it's been trading in a long time, okay? Price to expected growth. It's higher for retail, but again, cheaper than it's been trading, 1.7. And price to sales at 1.2 is, again, it's a little bit pricier for retail stocks. But I look at the P ratio, and it's one that I can't help but, take a bite out of. I love it. And why is that? You look at the revenue, and it's been beautiful. Look at the 2020 numbers and how they've still been growing by significant. This is the most they've grown in history. It was last year, and they're still continuing to grow off of 2020 numbers. 19% increase from 2020. What do you want me to say? What do you want me to say? It's incredible what they've been able to do. This is a revenue line that looks fantastic. I love it. What can I say? Do you need to know? Obviously you know what Target is. Look, I don't need to explain Target to you. You can understand what Target is. It's a retailer, okay? Standard retailer, great things. I love it. And I also love the dividend on this company. This is another reason why it's worth buying at this, because no matter what, you're not losing with this company. They're dedicated to the dividend growth. 53 years of dividend growth, 6.3% growth rate over the last 5 years, and a payout ratio only at 27. There's a lot of room to grow this dividend, even at a 1.5% yield, which isn't incredibly high, but it is a beautiful one when you talk about the fact that you're also getting fantastic share appreciation. When I pull up the dividend history, what do you want me to say? Look at the max and tell me this is not the most beautiful thing you've ever seen. What do you want me to say? It's beautiful. It's absolutely beautiful. This is darn spanking beautiful. Darn tootin', baby, darn tootin'. Massive, massive stuff here. I love the dividend on this one, and they've raised it significantly this year, which means great things for them. They're growing net income, they're growing revenue, they're doing it all, and they're able to pay out more to shareholders, including massive buybacks as well. This is a great, great, beautiful, beautiful company, okay? What else do you want me to say? So that's Target. That's why you need to buy Target. And then finally, it's another I have two retailers. Sue me. Sue me. I dare you. My legal team will crack down on you in a heartbeat. Kohl's. Why is Kohl's on here? Well, it's an interesting one. I like the CEO. But on top of that, this is a company trading at ridiculously cheap valuation. Ridiculously cheap. Year to date, they've been performing well. You look at last year, 26% growth. Last 5 years, though, there's not much to offer with this company. 11.81%. Nothing to offer. They recovered pretty quickly from their 2020 dip, which was significant. They hit great numbers in 2018, and then really have been falling ever since, and then showed some recovery in 2021 here, but not quite to the levels that they were in 2018. And I question why that is. Kohl's is a discount retailer most known for clothing, obviously, as you might know, but they carry a lot of other home goods and stuff like that in their stores, which have been performing incredibly well. And if you don't know why they sucked so much last year, these were companies that were forced to shut down because the government decided they could choose who were the winners and losers in the economy. That's just how it goes. That's how government rolls, baby. This is a company trading at a trailing PE ratio of 8. Do I need to say more? 8. Forward P ratio of 9. I don't think I need to say any more than this. Look, this is ridiculously cheap. Price to sales is at 0.43 on this company. Have you seen a stock trading cheaper? I don't know if you have, because it's trading pretty cheap. I don't know why Seinfeld came out of nowhere. This is an outrage. This is trading cheap. Look at the revenue line, and I see obviously last year you could see when they got absolutely destroyed. Absolutely destroyed. You saw some declines here in 2020 by significant margins. But we're on the way up, baby. Look at the green following this red. It's showing you that they're on the way up, and they're going to stabilize to where they were back in these 2017, 2018 numbers. They're going to stabilize to 2019 numbers. It's a company that's doing great things. They're working on online tech initiatives. Obviously, e-commerce is going to be significant for these to continue growing in the future. And with partnerships with Amazon, I think things are looking pretty darn good for Kohl's future, in my opinion. On top of the fact that, look, I like it's another dividend, baby. Starting yield at 2%. Now, they have declined the dividend in the last 5 years, and you want to know why? I think you know why. But only a 13 payout ratio, 13%, ridiculously cheap. You can see where the dividend history is at and why it shows a decline, and really how they are trying to grow that pretty quickly back up. Don't you dare, Seeking Alpha. Don't you do it to me. Not on the last stock. Not on the last stock. You can't. You can't. But it can. That's the thing about it. It can white screen me all at once, and I can't do anything about it. F5. We're hitting F5 again. Did that start? Was that a hotkey on OBS? I hope it wasn't, because if it was, we're screwed. No, it wasn't. I don't think so. Okay. What? Oh, okay. Okay. Look, that's the thing about us. We fight through these things. We fight through them, and you can't stop us. I think Seeking Alpha is just taking a poop for the day, and it doesn't want to talk about it. But just trust me. Look at the dividend history of Kohl's, and you'll see good things. Let's do it. Let's do it the other way. Let's do it the other way. NASDAQ, love it. NASDAQ.com always has a great numbers. Better than Seeking Alpha, clearly. Look at where you see the dip in terms of the dividend. Oh, that's weird. That's right. They paid a beautiful dividend right before they were forced to shut down. Then the government said, F you, we're shutting you entirely down, and they completely cut the dividend. Then they reinitiated it earlier this year at 25 cents. But you see where it was prior. It was growing significantly. I mean, you can see it. Look at this. From 2013 all the way to 2020, they were continuously growing by large ranges, actually. So this is a company that is dedicated to the dividend. It really is. And I think starting I'm going to enjoy that dividend payment in December, by the way. Starting 2022, I think they're going to start increasing it. I think that goes without saying. They're going to increase it. I believe they're going to start at 30 cents. Then I don't know for sure. I don't think they're going to start doing quarterly raises quite yet, but I think they're going to start next year at 30 cents. And then I think from there is when we'll see it kind of take off. At least every year growing 5 cents a share, and I think it probably grows larger than that. I think they could recover closer to the 50 cent per share range, probably by around 2023. I think mid-2023 they could recover to the 50 cent a share range easily. It's a beautiful dividend. I love this company. Coles, buy it!